Hello traders, and welcome back to Explain the Charts, your channel for in-depth technical and fundamental analysis. Today is Monday, September 29th, 2025, and we are diving deep into the USDCHF currency pair, which is poised at a very interesting technical level. First, let's quickly cover the news that's driving the fundamental picture for this pair. The primary story remains the stark divergence in monetary policy between the Swiss National Bank and the U.S. Federal Reserve. The SNB has been extremely dovish, implementing a series of rate cuts that have brought its key interest rate down to 0%. They're battling deflationary pressures and a rapidly appreciating franc, with reports suggesting a return to negative rates is a real possibility. This persistent dovishness from the SNB is a fundamental long-term weak point for the Swiss franc. On the other hand, the U.S. Federal Reserve is described as being decisively more hawkish, supported by a robust labor market. However, the picture for the U.S. dollar is becoming more nuanced. Recent PCE data suggests the Fed is on course for future rate reductions, which has softened the dollar against currencies like the Japanese yen. Furthermore, gold has been advancing against the dollar amid increased bets on these future Fed rate cuts. So we have a classic tug-of-war, a fundamentally weak franc due to the SNB's policies versus a US dollar that, while strong, is showing signs of potential future weakness. Now, let's see how this narrative is reflected in the charts. Looking here at the daily chart for USDCHF, the long-term story is undeniably bearish. Since the highs back in May 2024 above 0.915, the pair has been in a clear and sustained downtrend. We can see a classic pattern of lower highs and lower lows etched out over the past 16 months. There have been several periods of sharp decline, notably the drop from 0.91 down to 0.88 in June of last year. This downtrend reflects the market's reaction to the SNB's aggressive rate-cutting cycle. The selling pressure has been relentless, establishing a clear path of least resistance to the downside. Now let's zoom in on the price action from March of this year to get a more detailed view of the recent dramatic moves. The period from March to July 2025 saw a particularly aggressive leg down, with the price plummeting from around the 0.88 level. A massive wave of selling in early April took the pair from 0.855 all the way down to 0.82 in a single day, which was a huge capitulation move. Price continued to bleed lower, eventually finding a bottom in late June and early July, with lows testing below the 0.80000 handle. That 0.80000 level is a massive psychological and technical area, and news reports from July highlighted the market's focus on it. The chart confirms its importance, as we can see buying interest emerged right around this zone, specifically with the lows of June 26th at 0.7975. Following these lows, the pair staged a recovery rally through July and August. However, this rally stalled around the 0.813 level in mid-August before pulling back again. More recently, in the past few weeks, we saw another attempt by the bulls to push the price higher. This push culminated last week, on September 25th, where the price wicked just above 0.8000, reaching a high of 0.80138. Crucially, the bulls could not hold this level, and the price was rejected firmly. The candle from September 26 shows a strong bearish move away from this resistance, closing back at 0.7977. This rejection turns the former support level of 0.8000 into new, confirmed resistance, which is a bearish technical signal. To get an even closer look at this recent rejection, let's switch to the 15-minute chart for the last few trading days. Here we can see the anatomy of the battle for the 0.8000 level. On September 25th, you can see the series of bullish candles pushing the price up, breaking through 0.8000 and reaching that peak. However, momentum stalled, and what followed on September 26th was a significant and rapid sell-off, breaking back below all the recent short-term support levels. Since that drop, the price has entered a period of tight consolidation. We can clearly define a short-term range, with support around the 0.7955 area and resistance now near 0.7980. The price action since Friday has been mostly sideways, indicating market indecision after the sharp rejection. For day traders, this range is key to watch in the immediate future. A sustained break below 0.7955 would likely signal a continuation of the bearish move from Friday. Conversely, reclaiming the 0.7980 level could open the door for another attempt to challenge the 0.8000 resistance. Coming back to our daily chart to synthesize all this information, let's outline the potential scenarios going forward. The bearish case is currently the stronger one from a technical standpoint. The dominant long-term trend is down, and we just witnessed a clear rejection at a major resistance level of 0.8000. If the broader market sentiment continues to anticipate future Fed rate cuts, this could add further weakness to the US dollar, fueling the bearish case for USDCHF. A daily close below the recent consolidation support around 0.7950 would be a strong confirmation for the bears. This would open up a probable move to retest the multi-month lows around the 0.7900 area. Now for the bullish case, while technically weaker, it is supported by the fundamental interest rate differential. The Fed's rate at or above a quarter point is still significantly more attractive than the S&P's 0% rate, which should fundamentally support the pair. For a bullish scenario to play out, we would need to see a decisive break and, more importantly, a daily close above the recent high of 0.8015. This would invalidate the bearish rejection and suggest that buyers have absorbed the selling pressure. If this occurs, the next logical target for the bulls would be the resistance from the August high, up around 0.8130. So, to recap the key levels you need to have on your own charts. Immediate support is at 0.7950, the bottom of the recent consolidation. Major support is the multi-month low around 0.7900. Our key pivot level and now immediate resistance is the psychological 0.8000 mark, along with last week's high at 0.8015. Further resistance sits at the August high of 0.8130. Given the powerful long-term trend and the recent rejection, I believe the higher probability scenario, around 65%, is a break to the downside to test the 0.7900 lows. This would be reinforced by a daily close below 0.7950. The lower probability scenario, at about 35%, is a bullish breakout above 0.8015. The likelihood of this would increase with surprisingly strong U.S. economic data or more hawkish commentary from Federal Reserve officials. Keep a close eye on any upcoming U.S. labor data and speeches from central bankers, as they will likely be the catalysts for the next move. That's our analysis for today. Thank you for watching Explain the Charts. If you found this video helpful, please like, subscribe, and hit the bell icon so you don't miss our future updates.